All right, Carl, you want to kick it off here?
Yeah, sure. Thank you, everybody, for joining us tonight in this webinar. My name is Carla Iniguez Policastro, co-founder of Cycle CPA. A lot of you know me from my Facebook group, Landscaping Accountant. We're going to go over financial statements and cash flow and the analysis that goes into that. It's going to be packed full of information on how to approach the financial statements, how that tells a story, and then how to take action on that. So it's going to be a good one here. I also have Joe joining me tonight.
Hi, everybody. I'm a Cycle CPA as well, and looking forward to take a deep dive into the financials, and try to give you guys some of the tools here to really make sure that your business is running well. And this is going to be recorded. So if at any time, you have to leave for whatever reason, if you have to leave early, it will be sent. And if you have any questions, definitely use the chat on the right side of the screen. And then we'll try to get to as many questions at the end of the webinar there. All right. And we really want to, shed some light, having a lot of experience working, not only in accounting, right, but we work pretty much exclusively with green industry businesses. So, trying to really pass on some of that knowledge onto you guys. You guys work hard in the field, and we want to make sure that you guys are well equipped in the administrative side of the business as well. And there are three main phases to this, right? You have the accounting, whether you have in-house staff, whether you have an outsourced team, but then ultimately you want to use that information and analyze it for your business, and then based off of that analysis, you want to take action. So there's a couple phases here. We're going to focus on the analysis phase during this webinar here. And it could get overwhelming, right? If you look at your financials at the end of the month or at the end of the year, and you see that your overhead is very high or your expenses are very high, stuff like that. Take the same approach when it came to adding on those expenses. Make it very strategic. Go line item by line item, because there is always progress to be made. And don't only focus on cutting that expenses. Also know that by increasing revenue, it can also help out ratios and help to absorb some of the expenses within the business. And we also see sometimes it's great to have that focus on cutting expenses, but know that there is no cap to growing the revenue in your business. So it's good to focus on both, and that's ultimately where a healthy business is. It's that focus on growing revenue and then cutting expenses as well.
Yeah. And we need to catch problems early on. And like Joe said, you don't want to be there at the end of the year and say, wow, my overhead expenses were so high, but then, there's nothing that you could do about the past. So how do we catch problems early? First, you need to have your financial statements in order and, have financial statements sent to you or render them every single month at least. And once you have your financial statements and they're accurate, you can monitor patterns. And you as the business owner will have a good idea of any irregularities. So how can you monitor patterns? We're in September, right? So everybody should be receiving their August financial statement. And you can compare August to July. Did you grow in revenue? Did that increase? Your cost of doing sales, so your field labor staff, your materials, did that increase? And if it did, why? Gross profit, did that increase as well, or did it decrease? Once you start implementing these habits of, looking at your financial statements and comparing it to the prior period, like I did in that example, or you can compare it to the prior year, so January through August, and compare that to January through August 2020, you can really investigate into why some expenses increased and others didn't, or maybe why revenue increased or others didn't. So that's something that you want to keep up with within your business, because that's how you catch irregularities early on. Some overhead expenses should not increase at the same rate of growth that your revenue may increase. For example, I have an example down here. So revenue growth from 2020 to 2021 increased by 20%, let's say. But then you saw that your overhead growth increased at 18%. So that's great, because your overhead didn't increase at a much higher rate than your revenue. If your overhead growth increased at 40%, let's say, then we know that we're not doing something well in that area. So that's why it's important to analyze your financial statements to the prior period in the prior year. So the answer is not always pricing. We will take a deep dive into the financials. There are so many reasons why your financials could be off, and we're going to take a deep dive into every single line item and see why they could be off. So slight price increases may be more sensitive in some service areas than others, right? Maybe maintenance is more sensitive to price increases than design and build, So Joe, you could take it away here.
Awesome. Yeah, and it's important here to, I know that there are a lot more exciting things to spend your night on, looking at Excel sheets is probably not one of those things, but this is something that when it comes to building a successful business, there's one thing that we see that those companies that are able to scale ultimately are able to have accurate accounting and reports, and being able to make specific actionable decisions off of those. Now, when it comes to looking at your profit and loss statement, so for instance, we're looking at the second quarter of 2021. It's you can think of it almost in three categories. You have your income here, cost of sales, and then expenses, and then ultimately your net income, right? So looking at your income, right? You budget for the year. We're gonna make $1 million this year. That's what everybody wants. Everyone is always happy about the revenue. We went up by this much. That's always great, right? But what if you're not happy with your revenue, right? What if you budgeted, $1 million for the year, but right now you're sitting in September and you're only at, 500,000, right? And as Carla mentioned before, it's not always due to pricing. It's not always due to maybe, things that, make up your estimate. Look at things like labor shortage. And as you can see, I listed some of them here in this light pink color. So how is your sales team doing, right? Marketing and advertising, upselling, right? Are you tracking upselling? When you have some of your reoccurring contracts, are you going to them, trying to upsell them on other work? How are you collecting your accounts receivable, right? Do you have a process for that? Customer service, client retention. Are you retaining, some of these customers that you're spending all that money with the marketing and advertising? Are you actually retaining them? And bundling your services, really thinking about maybe having some of that off-season services. Maybe that'll help to retain some of your employees, right? Doing some of the yearly packages. We see more and more companies doing that, and that's something we definitely recommend, especially for cash flow purposes. And client concentration. Sometimes we see with some of our clients, let's say they have 50 clients, 50 customers, but 2 of them make up 20% of their revenue, right? So you always want to know that as an owner and be aware of that, because it could be more risky. So that's what makes up the income side, right? So, it's great to drive that, right? But then ultimately you have your direct costs, right? What is directly related to that revenue, that income that is coming into the business? You have the materials, you have the field labor, you have some of your equipment, vehicles, right? So that's all directly related to the jobs, right? And as you can see, that's in the light blue here. So really you want to be as efficient as possible, right? When it comes to the labor, you want to make sure, you're tracking things like some of the non-billable hours, right? You want to make sure that if the employees clocked in, if that field labor employees clocked in, that those hours are going towards producing income, right? Because they're directly related to driving the revenue. Can you focus on, looking at different bulk discounts on material during the off season, building better relationships with vendors? I know one of our clients, even posted in the Facebook group how even a picture of a gift that he sent to the vendor, which is awesome to see. And not only doing the accurate estimating, but making sure that that you are doing some sort of job costing, right? I know sometimes it may be difficult to apply some of the overhead and stuff like that into the estimating, which you should be doing, right? But at the very least, you should have a very good idea when it comes to this blue area, right? That those direct expenses. There should be no doubt there. And should you think about getting an on-site fuel tank? Some of our clients have started that. Also reducing some of the idle time. And as you can see, the list goes on and on here. When it comes to the AM and PM unload and load, really making sure that process is efficient, because if you have 10 employees and you're wasting 10 minutes, that's 10 times 10, that's 100 multiple there. So really looking at smart equipment buys as well, right? Because if you see that your field labor is very high, right? A way to make that more efficient, right, is to get better performing equipment. So which will ultimately help to drive that gross profit up, right? So building route density. I'm sure you guys hear that all the time, right? But all of these things play a huge role in driving down that gross profit, driving up the gross profit. Sorry. So, it's great. You're getting that income up, right? Your cost of sales look great. You're keeping them low. Now, what's keeping you from making the rest of that money that's left over? What everybody loves, the overhead expenses.
Yeah, no, we don't like overhead expenses. Like, everybody forgets about overhead expenses, and then it comes back to like not be so pretty on the financials. So we really want to track overhead, because a lot of the people we talk to, a lot of the landscapers, they forget all about overhead expenses, and then their gross profit looks healthy, and it's in line with industry benchmarks, and it's great. But then when you get down to overhead, it really kills them. So
absolutely. And one thing about, especially as you start a business, this may not be something that you track as closely, right? In the first couple of months, you're just trying to get work, right? But as you grow, you want to keep a close eye on this, and even for the larger companies, right? It becomes, this is part of the game, as you scale, to control your overhead. That's part of the game here. So making sure that you have accurate accounting, where you're able to get these reports is crucial. So some of these expenses, right? Some of the overhead expenses, these are the expenses not directly related with the jobs, right? So how efficient is your marketing, right? Implementing a CRM, looking at things like Aspire, Jobber, Element, Service Autopilot, it saves time. That's the bottom line. Trying to go paperless in as many things as you can. I know that there's some things that, it can get difficult, but try doing what you can do in that area. Look to outsource some of your work, right? Maybe your payroll, HR. If you're very small and you don't want to be taking calls and you're working in the field, have a call center handle it. These are very cheap options. This is one of the benefits of using an outsourced accounting firm like Cycle CPA. You can basically use what you need. You don't have to go out and hire a part-time person or a full-time person. The smaller company you are, you can have these outsourced companies handle that function. Even if you're a larger company, right? Instead of hiring, a full-time controller or CFO, maybe you don't need a full-time person. Maybe you just want that guidance. Maybe you don't want to hire a HR person, but maybe there's an outsourced HR company that can give you those solid handbooks, right? So you can feel confident that, if something legally comes up, that you feel safe, that you can make those important decisions. Shop around for insurance. Always be reviewing your general ledger for some of those expenses and monthly subscriptions that maybe you needed when you first started, or maybe you needed last year, but it's just not necessary now. Because little improvements in each line item in the overhead make a big difference. So you always want to be checking. I know we internally even switched recently to Bill.com from QuickBooks Online when it came to the ACH. Saves, little changes like that can improve your overhead. If you have managers, make sure that they're doing manager tasks, and if they're looks like Tano said tacos are killing my expense report. That's
Mine too.
Oh man. Yeah, but it's if you hire a manager, maybe there might not be enough manager tasks for him yet, but that's where you want to get him, right? Especially as the owner, you want to make sure that the manager is letting you work more and more on the business, right? And really, especially in these days, everyone tells you how hard it is, right, to find labor, right? But that same effort should be put into into employee retention. How do we retain these employees? How do we make them happy? That's where even more of the effort should be put, because how much will it cost you to replace them? That's something to really, really think about. Do you have meetings that are not necessary, or do they typically go way too long? Is there a strategic way to make the meeting shorter? So there's a lot of different adjustments that can be made, within the business. And I think breaking it down in this simplified way, looking at it in the 3 areas, because ultimately, you may look at your report and you may see one of these areas is doing a lot better than you had budgeted, right? So it helps you really focus in. Now, as I scroll down here, this is an example, right? As someone that owns a business, or if you're in the financial department, you're always looking for, as Carla mentioned before, different patterns to see, right? Different items to focus on, because ultimately, and I just spoke about meetings. It's great to have meetings about things, but you got to go and do things after. You got to have some action, right? Now, this is a report. It's showing the second quarter of 2020 in comparison to 2021. So here in this middle column, you can see that the revenue went up from 300,000 to 400,000. That's a 33% increase. Fantastic. However, you can see that from 2020 to 2021, the gross profit only increased by 25%. Now, some may kind of look at this and maybe not be paying attention as much and say, "Oh, that's great. We increased by 25%, right?" But that's why it's always important, right? Because it's relative. It's relative to how you're doing in your revenue, right? So if your business is growing by 33%, but your gross profit's only growing by 25%, then that means that there's some work to do in here, right? Your direct labor employees are not being efficient, but we know that may not be the only case. It may be that they don't have the right equipment, right? Which is not necessarily their fault. It may be that any of these items listed that I listed in blue, right? So, and then as I scroll down, we can even see 2020 numbers compared to 2021. There was a 25% increase of the overhead costs, which, as Carla went over in the initial slides, ultimately some of the overhead expenses stay relatively fixed. Think about it. For larger companies, you hire a CFO or you have a COO. Whether you're 5 million or 10 million, generally, you're only going to have, that COO, and their salary may increase a little bit, but not the same rate as the business is growing, right? So there are some relatively fixed overhead expenses. So ultimately, this is fantastic, seeing that it only increased by 25% because the business grew by 33. So that's a fantastic cushion there. But then ultimately the net income, right? So what's left over, 24% increase, which is bad in comparison to the 33% increase of the revenue. So again, looking at this financial, what does it tell you? It says that they're doing great with the overhead. Their administrative and employees and managers are doing great. But as for some of these items up here in regards to the direct labor, that's where they're really falling short. Now, that was comparing one year to the next year. Now, this is something where you're comparing the numbers in a relative percentage to the total revenue to industry average, right? So looking at, things like your landscape installation income, maintenance income, seeing what percentage of that it is to sales. And looking at things like job site materials or payroll field labor and comparing those percentages to the industry averages. So you can see, you can even take a weighted average. If you know what the industry average is for maintenance or landscape install, you can take that weighted average, and that's what I did with these percentages. So you can see that it's great. We did a lot less in materials than industry average, but for the field labor, we did slightly more, which is not a good thing, right? Because you always want to be better than average. So if you're less than average, that's, you definitely have some room to grow there. And then ultimately you see where your gross profit matches up. It's doing a lot better than industry average. So, overall you're doing well with your direct expenses. But then as you scroll down here, you can see that your total overhead, 29% of the revenue in comparison to industry average, which is 27, right? So that says that so looking at this profit and loss in comparison to industry averages, you can see that you have a lot more to grow when it comes to improving on the overhead piece. And here's an example of another way that you can do an analysis, within your landscape company, is comparing it by divisions. You have the arbor services and hardscape, right, for the same period. And similar to the top example, you basically, you run the percentages based off of the total revenue for that division. So you can see here that your hardscape division is doing a lot, is doing worse, when it comes to the gross profit. So they're only at about 33% gross profit. So which means that after their direct expenses are accounted for, there's only 33% of the revenue left. And then you can see hardscape, is really running into trouble here, when it comes to some of their managers or admin staff that is allocated to the hardscape division. Looks like they had some more maintenance on the vehicles, which ultimately puts them in the red, right? So they were negative for the month. Now, these types of reports where you're comparing service lines are incredibly important. And whether you're $100 million company or $1 million company, the more detailed that you're able to get, and when I say detailed, is breaking it down by service line, breaking it down by division. That's ultimately how you're going to have a clear picture of what's going on in your company. One of my previous roles in the past, I was with a very, very large business, and they had many different locations. Dozens, right? But each location actually held their own profit and loss. So the COO was always able to go to those managers and even practice some open book management to see exactly how that division was performing, right? Because the way that a business becomes profitable is not by looking at the entire operation and saying, "Oh, okay, we're at 15% profit." You have to look at each division of the company. That is the most important takeaway that you'll get from this webinar, because if you get to that point, then that's how you scale it, right? Then you add another department and they're profitable. Add on another department, but then after the fifth division that you add on, you have to know how profitable that first division still is, right? So you always have to keep tabs on that. Incredibly important, no matter how big you are. And we deal with some large companies, but some of them, especially when we start off working with them, it's just not something that they see clearly, and it's it can and as Carla mentioned earlier in the webinar, you want to catch things early. That's the key. That's the reason why you keep up on financials, right? That's the reason why you have it month to month to month, and you monitor it in that basis, not just at the end of the year. All right. So I hope that I was able to give you guys a good understanding of some of those items, not only some of the boring stuff, but, as I mentioned in the top, some of the things to kind of push you guys, give you some ideas, get your brains going today, and different things that you can do to make immediate improvements. All right. So I'll hand it off to Carla here to continue with some of the other statements.
Awesome. Thank you, Joe. No, that was great. And I think you really portrayed how your financials and the numbers really do tell a story. And, you may look at your profit and loss and see a bunch of numbers and a lot of money, and it could get overwhelming, like you said. But then when you break it down to each category and see what's really driving those numbers. What are the cost drivers is really where you can get creative and start cutting down on costs and really implement efficiencies, growth within the company, and catch it early on. So thanks for that. And now I'll move on to some more boring things like the balance sheet. So let me share my screen. Awesome. So here we have a balance sheet, and so under your current, so your balance sheet shows your assets, your liabilities, and your equity accounts. And so on top here, we see your current assets, which show your checking accounts and your savings accounts, things of that nature. Your fixed assets are your furniture and equipment, machinery, and your vehicles, and your accumulated depreciation. So I like to say that your fixed assets are anything over $1,000 that benefit your company for more than 1 year. So your vehicle, you're going to use, over 4 years or 6 years, right? It's not going to be all, you're not going to just use it in 1 year. So, for example, if you purchase, a vehicle and you paid, $15,000 for it, you're not going to expense all of that in one shot, because you're going to amortize that over, X amount of years, however many years that you're going to use it. So that's why these items are on the balance sheet and not on the profit and loss statement. And what is on the balance sheet is your depreciation expense on these assets.
Carla, just hang on one second. I think people are having trouble seeing it. It looks like not sure.
Let me unshare and reshare, if that makes sense.
Yeah, give it a shot. Thank you guys for letting us know. We're gonna try to get this going here.
Technical difficulties. I know.
Did Zoom technical difficulties even exist before COVID?
All right. Can everybody see it now?
All right. Okay, looks like we're in business.
All right. So what I was going over, so just quick, current assets are up here, which are your checking, your savings accounts. And then you have your fixed assets right under that. So again, that entails your furniture, equipment, machinery, vehicles, anything that's over $1,000 that benefit your company for more than 1 year. So your car, you're not just going to, purchase it and use it in 1 year. You're going to use it over multiple years, right? And so that's why we see your vehicles, your dump trailers on the balance sheet and not on the profit and loss statement, because you're not going to expense these amounts all at once, because you're not going to use them all at once. You're going to use them, over X amount of years. So the way we do it is we post what we call book depreciation, not tax, because tax, you have some rules and you can only depreciate it this amount and for these amount of years. That's different. Book depreciation allows you to chip away at these amounts over the years that most benefit your company or is clearly more correlated with your company. So if you know that your vehicles, you usually use them for 3 years and then, you get rid of them, you purchase new ones, then you know that the vehicles you want to depreciate over 3 years, right? Or your machinery and equipment, you usually use it, those for 7 years. You're going to depreciate it over 7 years. So you're going to chip away at those amounts year by year, and then you're going to see it on your profit and loss statement as depreciation expense. So that's why we see again, that's why we see all of these assets on your balance sheet and not on your profit and loss statement. What we see on the profit and loss statement is your depreciation expense. And as you can see down here, the accumulated depreciation is a negative number because that's the amount you've been chipping away at, right? So that's why it's negative. It's subtracting the asset amounts, right? And chipping away at it. So then you get your total fixed assets. So we have your current liabilities, which are your credit cards, anything that you're going to pay off before the end of the year. So your sales tax payable, your payroll liabilities, things of that nature. Your long-term liabilities are items that you're going to pay off over more than 1 year. So that's your loan on your mower, your loan on your vehicle. It's very, very important to reconcile these loans every month or at least every year. I can't tell you enough how much times I've seen where these loans are not even on the balance sheet and they're not even reconciled. And that's bad because that means that no one has been posting interest expense on these loans. And so you're losing out on a tax deduction. And I've seen it happen to large companies and I've seen it happen to small companies, and it's not a good thing. So make sure you reconcile your loans, everybody. And down here we have your equity section. So what does the equity section make up? So all of the business owners want to know and are very invested in their equity section, right? Because it's the equity within the company, especially if you're going to sell or if you have plans of selling in the future, this becomes very important. So what is made up of that? So it's made up of retained earnings. That's our first line. And it's, earnings that are retained within the company. So if you had net profit last year of 10,000 and then the year before of another 10,000, then that means your retained earnings are right now 20,000. Or if you had a loss of 10,000 and a loss again the year before of 10,000, now your retained earnings are all of a sudden negative 20,000. So retained earnings increase if you have net income, or they decrease your equity if you have a net loss. Owner's draws, right? We all like those. Those are going to decrease your equity account, right? Because you're pulling from the business. That makes sense. And then your owner's investment account, that is what you invest into the business. So whether that's cash or property, that increases your equity accounts too. So you have your total equity, which, during the first, couple of years may be a negative number, but you really want to work towards making that a positive number. So that's what that consists of. It's really important to also look at the balance sheet, just how you look at the profit and loss statement, because your balance sheet can tell you things like your liquidity and your profitability. What are you getting the right return on your assets that you've invested into the business? Are you getting a high return on your high reach or your Bobcat? Are you getting a good return on the equity that you've invested, the money you've invested into the business? Those are the things that the balance sheet are going to tell you, and you're going to be able to make decisions off of that. So we have liquidity measures. That's how fast can you pay your upcoming liabilities? Are you able to pay your payroll? Are you able to pay that sales tax liability? How can we calculate that? We can use the current ratio. So that's current assets divided by your current liabilities. Again, your current assets are up here. They mostly consist of your checking and savings account divided by your current liabilities, things that you have to pay within the next year. Anything over 1 is good in this area. You have your debt to equity. So you have your total liabilities divided by your total net worth. So Again, here are your total liabilities divided by your total equity. Your ratio should ideally be under 1 and definitely not over 2 in this area. Again, this is what measures your liquidity within the company. So can you pay your upcoming liabilities? That's what that's going to tell you here. Next is your profitability ratios. Return on assets. That's a good one for this industry, of course. Your net profit, your net income, however you like to call it, divided by total assets. So these are your total assets, right? And what this typically is referred to as is your ROA. It shows you how efficiently and effectively you're using your total invested capital plus debt. So as a landscape contractor, you should expect a high return on your investments. A good goal to reach is 15 to 22%. So you want to make sure that your assets within the business are used efficiently, right, to turn that profit. Return on equity, net profit or net income divided by your total equity. This shall land anywhere between 25 to 35%. This is usually called ROI, a return on investment. It's a measure of the return earned on the money you've invested or other investors have invested. So your net income divided by your total equity. That's your ROI.
And I think, one of the ways to kind of think about that figure is if you were an investor, if you brought your business to Shark Tank, if you brought it to an investor, would they invest in it? That's something to always kind of look at. Going along the same lines of, always trying to take the approach that you may have to sell your business tomorrow. Is it at that level? So that's what these equations help. If you're approaching a bank, some of these ratios are very important.
Yep. You also, you definitely want to know your return on investment within the business. So again, anywhere from 25 to 35%. Another measure is asset newness. So that's your net fixed assets divided by your gross fixed and non-current assets. Again, this ratio should be between 0.4 to 0.6. If it's too high, you might be spending too much on new equipment. If it's too low, you may be dealing with a lot of outdated equipment and maybe time to, upgrade. So what does net fixed assets mean? So it's your asset amount and then minus the accumulated depreciation. That's how you get your net fixed assets. Your gross fixed assets are how much those assets cost, so you're not going to subtract depreciation and non-current assets, any other fixed assets that you have. Asset turnover, so total sales divided by your total assets. A good goal is anywhere between 2.5 to 5. This is a measure of how effectively and efficiently you use your assets to generate sales. A low number may mean that you've invested more in equipment in the facility that you really need, or that you're not using it as effectively as possible. So it's important to keep track of this measure again to see how maybe you're doing with the usage of your equipment versus your sales. So that's what that will tell you. And, really looking into these ratios here are going to help you make the decisions that I mentioned in the beginning. Can you afford certain items? How is your profitability doing? Should you upgrade equipment? things of that nature. Awesome. So moving on to the statement of cash flows here. Let me just, there we go. This is one of my favorite reports, right? Because it's pretty straightforward in terms of what it tells you. So it's cash in and cash out, what's left over in the bank. The statement of cash flows report could be a little bit tricky to read, but I'll point out the line items that you need to pay attention to. Pretty much what the statement of cash flow does, it takes your profit and loss statement and it takes all of that those accounting items and like reverses it for you and, you know, tells you, okay, this is cash in, cash out. That's what it's doing. It's like reversing out the profit and loss statement so that you can land to, okay, this is what my cash position was at the end of, for example, August here. So that should match what was in your bank. So the statement of cash flow, really what it does, it reconciles to your bank account from your profit and loss to your bank account. Think about it that way. So you start off with your net income up here. And then again, it's reversing some things with some accounting stuff here in terms related to your operations. So it's adding back accounts receivable, accumulated depreciation, because that's not a cash item, right? Credit cards, liabilities. And then you can see here the total adjustments to reconcile to net income to net cash provided by operations is a negative number here, negative 2,537. Net cash provided by operating activities, 107,000 about. Then we go down to your investing activities. Did you invest into any assets? So this company did. This company purchased a computer, some machinery and equipment, and vehicles. And then, there's some loans associated with those purchases. So here are the loans, the financing activities. And so you can see here that this statement was from January 1st to August 31st. So what it's saying is that, and this is the items that you want to read really, is, okay, what was my cash at the beginning of the period? So what was in my bank account on January 1st? 3,346. What did I end the period with? What did I end August with? 1,400. So what that means is that my cash decreased for that period. That's why that's negative here. $1,945. And so we're looking at this and we're saying, okay, the profit and loss looks great. We're 110,000, in net income. But then at the end of the period, we're only left with $1,400. So again, this is why it's so important to look at this statement, because your profit and loss doesn't tell you this. And so if you look at your statement of cash flows every month, you get a good idea of what your net cash, that changes over period to period. And so you're able to make decisions like, on average, I usually have, $2,000 left over in my bank. Maybe I should set some aside for an investment into my equipment or create a cushion for operations. And you have a good idea of this is what I have left over each month. And so it will help you make those business decisions that you'll need to make, later on. So that's what the statement of cash flow is good for here. Or buy more tacos. Yeah, of course. You have to see what your taco fund is looking like. Awesome. So we have a cash flow forecast that we have for our clients, and most businesses in the U.S. Go out of business because of cash flow issues, right? So having a cash flow forecast is key. And even if you start with the simplified method of this, anything that helps you forecast out where your cash is going to be over the next months is going to be great. Here I'm going to go through a simplified method of what we use for our clients. To forecast, we forecast out the next 6 to 12 months worth of revenues, direct costs, overhead costs, the loans, all of that good stuff. And so a cash flow forecast is great because it's great for the seasonality of this business. You can forecast whether in November you're going to be in a cash flow crunch. If you plan for the future, you can sleep better at night, right? You don't have to worry about November or December. Am I going to have enough money? Because you can do something about it now if you can forecast that out. It helps with scenarios. So I want to make an investment into a truck. I want to put $10,000 down. Is that better to do next June, next July, next August? This is what that will tell you. Which months are better months to buy. That's one scenario. Another scenario could be you're looking to add on another office manager or production manager. When can we do that? Can we do that? And if we can I afford it? What will be my cash left over at the end of the period? What is that going to look like, right? So there's so many ways, you can play around with, okay, if I increase my advertising this much, how much sales will go up, how much everything else is going to affect. So scenario planning is great. Where is my current growth rate at? And the past financial data is what we're going to go over. So again, I'm going to go over this. This is a simplified method of what we use for our clients, but I think it's a great place to get started. So let's get started here. So let's say you have your Excel sheet pulled up, you're ready to go forecast your sales for the next 6 months. So what you'll need in order to forecast the next 6 months. So let's say we want to forecast September 2021 all the way to February 2022. What do you need? You need 2019 revenue numbers and 2020 revenue numbers. We like to use 2 years of historical data. But if you don't have 2019, that's okay. You can do this with just 2020 data as well. So here we have for September that in 2019, this company made $20,000. And in 2020, this company made $25,000. So that's a growth rate of 25% from 2019 to 2020. We have 25%, and you do that for the next 6 months, right? Okay, so that's your first metric that you'll need to forecast your sales for September 2021. The second metric that you'll need to calculate is the total sales for the trailing 3-month period before the first forecasted month. So the first forecasted month is September 2021. That's the month that we're trying to forecast compared to the 3-month total from the previous year. So we're trying to forecast September 2021. I need to know August's revenue, July's revenue, and June's revenue for 2021 and 2020. The reason why I want this information is because that is what the company is currently trending at. Like that's my most recent data that I have for revenue. So I want to calculate what is my company, what is my company's growth trend at now. So here I have, again, August, July, and June, right? So I have that in June 2021, I made 50,000. June 2020, I made 42, and so on. So these 3 months here add up to 130,000 in 2021. And in 2020, for the same period, it added up to 113,000. So that growth trend, 113 to 130, is 15%. Okay, great. I have my September year over year, 25%, and I have my current growth trend at 15%. Now what's next? I need to marry those two variables so I can forecast September 2021 sales. How do I do that? So you can use the growth rates from number one, 25%, and number two, 15%, to determine a weighted average multiple to complete the forecast. So in the forecast below, I use both rates, and I put a weighted average of 50% to both rates. So how does that look like? So for September 2021, the projected sales calculation goes as follows. So I have $25,000 September 2020 here. I'm going to take the most recent historical data for that month, right? 25,000. And I'm going to times it by the growth rate, 25%, right? 1.25. And then I'm going to times that by the weight that I'm putting on this 25%. I'm putting a 50% weight on that growth. Okay. So then I get a number. Then I'm going to add that number to this calculation here. Take the most recent month, right? For, the month that I'm trying to forecast, which is September 2020, 25,000. And I'm going to times that by this growth rate, 1.15. And I'm going to times that by the weight I'm putting on this growth rate, which is 50%, right? So 50, 50, 100. And then I get a total of $30,000 that I'm projecting in sales for September 2021. Now, in this example, I used a weight of 50% on this growth rate and 50% on this growth rate. But if you say, hey, listen, Carla, I think that my current growth trend is really a more clearer picture of where my company is really, heading, how my company is really going to grow. It's going to be more like 15%. Okay, great. Weigh that percentage at a higher weight. So use a weight of 75% on this 15% and just weigh this at 25%. But the key here is to use both and marry the two and allocate the weighted averages, because one is showing you historical information, which you need, right?
Which is good for the seasonality aspect of it.
Exactly, because you need to know what September was specifically. And then the number two, you're using because you want to know what your company's growth rate is currently trending at.
So what was the past 3 months? So we're sitting on September 2nd right now. What is September going to show us? What are we going to do in September, right? When it comes to cash coming into the business. So we're going to look at the past three months of 2021 in comparison to last year, right? That'll show us how we're growing right now currently versus looking at it, as of the future 6 months. So looking at this September, October, November, December, January, February, back in 2020 in comparison to 2019 to show us the seasonality of it as well. So
exactly. Perfect. So we have the 2021 projections down here for each month. So that's how you project your sales, right? But then how do you project your expenses and all of that good stuff? You're going to use the same methodology in your expenses to project that, amount. And then once you have your sales, your projected expenses, then you can, add what your, ending balance, for what was your ending balance in your bank account for August? It was at 2,000 plus your sales minus all your expenses. Okay, what's my projected balance in my bank account going to be for the end of September, October, and so on?
yeah, and so let's say you're sitting here in September and you see that, that your 2021 projection in October is 30,000, but then November is 18,000, and you want to buy a truck for the snow plowing season. Maybe you should make that decision sooner in October rather than doing that in November. So that's one example of how a cash flow forecast can be very, very beneficial for you.
Exactly. Great. Perfect. So I'm at the end of the slides there. So now we'll take a couple of minutes to answer any questions. So please insert your questions there in the chat box. Look here.
So Carla, Tano said, how would you track depreciation when buying equipment, cash or buying used equipment? Would you just claim that as a supply or material or still as an asset?
You would still, again, I say anything over $1,000 that benefits your company for more than 1 year. So even if you're buying it used, it's still going to benefit your company for more than 1 year. And so you would still, put that as an asset on your books. Yep.
Yeah. And Jane said, what about detailed cash flow forecast on a month-to-month basis? Absolutely. That's what we do for some of the clients that want that sort of service.
Yep.
But as we also showed, it is something that you can come up with through the Excel sheet as well.
Okay, perfect. So let's see. Okay, I saw that someone asked, like, how do you keep track of expenses per division, and what is some of the ways that you can do that? So if you're using QuickBooks Online, you can set something up called classes within QuickBooks, and that's where you set up your division. So you set up a class for each division that you have. So, and how do you keep track of the expenses? A lot of our clients will have the field staff write on the receipts which division those expenses go to. And then once you log into QuickBooks, you can allocate those expenses accordingly with the receipts that you have in hand. Another solution is that you issue a card to your employees, whether, if it's a credit card. And this works if your employees don't really overlap in the divisions that they work in. So if you know that Justin, he works in the maintenance division. So, every time he uses his card, you just allocate those expenses to the maintenance division. So those are two ways that you can use to do that. Or a lot of the CRMs, like Jobber, can, have the expense tracking that when you can take receipts, pictures of the receipts, on those apps.
Let's just scroll through the questions here.
Says, what is the best way for a new 3-month-old company to start tracking finances? I would say definitely run everything through your business checking account. Open a business checking account. Run everything through there. That way you have the information in your bank statement. And then, if you want to look into QuickBooks online for the essentials, it's something like, $35 per month or around that area, where you can, connect QuickBooks to your bank account, and then you can sort through your expenses and categorize all of those. Perfect. All right. So I think that was all of the questions, but yeah, I enjoyed talking with you all tonight. And again, thank you for your time, and thank you, Joe, for joining me. But if anybody has any questions or needs help with any of the items that I described here, we do these meetings on a monthly basis, where we go over the profit and loss by division. We benchmark to industry averages for every division. We do the cash flow forecast and the budgeting, and go over those items. That's the services that we provide at Cycle CPA. So please feel free to email me or give me a phone call, and join our Facebook group called Landscaping Accountant. We post on there often and provide a lot of tips and tricks on there. But yeah, it was nice seeing you all, and have a nice night. And thanks, Joe.
No, thank you, Colin. Yeah, everyone, I hope you have a nice night, and stay safe. All right. Good. Best of luck with your business. All right.
All right. Bye.